Good afternoon, traders and investors. Will back here with another one, coming to you with a Tuesday market recap. Hope everybody had a very beautiful day of trading. And in today's markets, guys, well, the story of rotation from big tech into pretty much everything else simply continues at this point, guys. And we've been hinting at this for the last 2 weeks of trading, how there was some concerns over concentration into big tech and everything else kind of being left behind. A lot of people were saying, well, if big tech takes a little bit of a pullback, that may be a top signal for the markets, especially if the rest of all other stocks don't really do much. Well, after last Thursday's CPI, all of that shifted. A lot of money is now rotating from big tech to the entire rest of the market. And that's for really two simple reasons that we discussed on last Friday's video, guys. Number one, the big tech trade was a very easy trade for a couple of reasons. 2 reasons, as a matter of fact. Number one, well, obviously you have the whole AI and infrastructure build-out narrative. And the best beneficiaries of those are your hyperscalers, otherwise known as your Magnificent Seven names, and infrastructure plays in the semiconductor industry. So the AI narrative was heavily helping to boost those companies' share prices. But number two, another reason that a lot of people were investing in big tech was as kind of a safe haven trade. In an environment where we have rising interest rates and high interest rates as a whole, you want to go with the companies that are the best positioned in terms of who has the most cash on their balance sheets to weather the storm. And that undoubtedly was big tech. And now, guys, now that your CPI is really starting to come down hard, and now that your rate cut odds for September are very, very close to 100%, the rate cuts are around the corner. So now it is time for a lot of institutions and retail to pivot from the safe haven AI hype trade into everything else that's kind of been left behind. Think of value, but also small cap growth as well, which is also known as the risk on trade. So in today's video, guys, I have a couple things prepared for you on that topic. Number one, we're going to go over a few company earnings, but we're going to do them in rapid fire format. We're going to cover pretty much the major earnings that happened today: Bank of America, United Health, Progressive, and Charles Schwab. Thereafter, guys, we're going to do those very, very quickly in rapid fire format. Don't want to spend more than 10 minutes on all four of these companies. Then we're going to take a look at some trades that I maybe have as trade idea setups for that rotation into value and into the risk on trade. So I have a number of different trades prepared for you guys. So I'll do those right after earnings. Thereafter, we're going to get into our regular technical analysis portion of the video of our major stock market indexes, and then into our big tech names and see, even though big tech is on the decline, where are the possible levels that we might be able to pick them up at better valuations. So, and then after, guys, once again, we're going to take a look at a few of the trades that I made in my portfolio, but just do a very brief recap. So a lot to cover today, guys. Very, very exciting video to say the least. Let's get right into it. So SPY up 0.59%, QQQ only up 0.04%, but the rest of the market doing tremendously well. Take a look at the heat map, guys. Stark contrast from what we've been having over the past 4, 5, 6 months, where usually your big tech names were the outperformers and the rest of the market was kind of either mixed or lagging behind. Well, ever since last Thursday's CPI results, guys, it is completely shifted. The bottom half of the market doing all of the lifting, and big tech just taking a little bit of breather after carrying the entire market on its shoulders for almost a year at this point, guys. They do deserve a little bit of a break, right? But it's nice to see everything else running at the same time. On the one-day relative, guys, you can see that even better expressed here. Almost every single sector in the green. The only ones that were barely flat or down were technology and communication services. Communication services led to the downside, obviously, by Meta and Google, their largest holdings in that subsector. So, in terms of the rotation, guys, that's pretty much everything, right? However, we are going to get into some earnings, going to do a earnings rapid fire right now, and then we'll get into those juicy trades that I'm preparing for that value trade rotation. So moving on in, guys, let's do these pretty much in order, right? So number one that we're going to cover, guys, is a big one, and I had a position in this one leading in today. It was United Health Group, right? One of the largest stocks of the Dow Jones. So UNH completely, absolutely crushing their earnings estimates. And that's exactly what we were expecting as well. So they really beat on everything. They beat on earnings, beat on revenue as well. They have decent margins in terms of premiums collected versus premiums paid, and everything is going good with the company. They reiterated guidance for EPS and for revenue for the remainder of 2024. So no red flags for the company whatsoever. We were really bouncing off this beautiful support zone. And luckily enough, we did cover this stock on the Saturday trading session. I actually had a position in this one myself, and happy to say, guys, that after today, we had a 100% profit in this trade. If you want to view a more in-depth analysis on UNH, just go watch my last Saturday subscriber videos. I spent about 5-6 minutes covering UNH in detail, but as a whole here, guys, extremely healthy company, no red flags, and I do believe they will be one of the runners in this value-oriented rotation, especially being one of the leaders of the Dow Jones. It would not surprise me if this one just continues pushing new all-time highs after really being stuck in a range here, guys. The past 2 weeks, very nice monthly accumulation, and now we're probably getting ready for that breakout. So I really do think that there is some continuation left in this trade. Fundamentals of the company are absolutely amazing, and those were reiterated on today's earnings, looking very, very good, and could potentially be one of the largest winners in the event of a Trump presidency. So just keep that in mind. Now, number two, guys, that we're going to be going over is all of our banks, right? Well, actually, let me do the banks at the end. Let me cover Progressive stock. Progressive, one of your larger interest, or rather insurance players in the game right now. And you can see they've been pretty much consolidating in a very tight range at the all-time highs ever since essentially the month of April. Why has Progressive been doing so well over the course of this year, guys? Even though it's an insurance company, well, you don't need to look too far. You guys remember this graph that I bring up every CPI? Which one is the outlier in terms of pricing power throughout the year? It is definitely auto insurance. They've been generating tremendous premiums, and today's earnings, even though this candle is pretty much down on the day, their earnings were amazing. Nothing bad to say about the company at all. Very nice beat on EPS, very decent beat on revenue as well, and they're really coming back to what made this company great. They did have a little bit of a hit here in 2021 and 2022 as a result of the pandemic. That was normal, but now they've regained a lot of their pricing power, and you can see EPS is going onto the normal expansion curve that it had prior to the pandemic. That's very good, and revenue just consistently continues to outperform. Extremely strong company. The only thing that I have to say about this company is the valuation is a little bit high in terms of their historical averages. Usually this company trades, anywhere between a 10 to 16 PE ratio when things get really, really hot. And since, 2022, 2023, it's been largely above that. Right now, it's sitting at about a 22 for trailing PE ratio. And even their PEG ratio, guys, is not that good, right? Even considering the fact that 2024 is really going to be an outlier year for them, right? So we have a really big gap in EPS here, 2023 to 2024. I don't really like taking that into consideration when I do an analysis because it's an anomaly, right? So we just take streamline growth 2024 through 2026. These 3 years on a growing basis, we end up with a PEG ratio of 2.11. So the PEG shows it's a little bit expensive. The PE ratio in relation to its most recent history shows it's a little bit expensive. Even the technicals, guys, right? Monthly overbought conditions as well. But we can't deny how solid this range is and how well this company stands to benefit from elevated premiums for the remainder of the year. So I would not mind taking a little bit of a technical trade setup on this. If we were to take it from here, guys, juicy trade for some potential all-time high continuation. However, my stop losses would be tight. They would really be below the $200 mark because that would really invalidate this whole weekly tightening range and send us into a weekly downtrend, potentially for more monthly consolidation. So that is how I would play Progressive on this one. I like it from here, but I would keep a relatively tight stop loss under this $200 mark. So maybe risking $10 to the downside and looking for upside, maybe $220, $230. So decent risk to reward still for a very solid company. Now, moving on, guys, let's cover some banks, shall we? So let's cover number one. We're going to cover the disaster that was Charles Schwab. And yes, I did close my trades. We're going to get into that to the end of the video. Close the trades over here for, a relatively okay loss. It wasn't substantial, but I'm happy I closed them out right here because if I would have held them throughout the rest of the day, it would have really been bad. Now, moving on, we're going to cover that at the end of the video when I show my trades here, guys. Charles Schwab, what exactly happened, guys? Down pretty much 10% on the day. Well, they did not have a very good quarter at all. 2024, I'll remind you, is a transition year for the company. They got hit pretty badly as a result of heightened interest rates, and especially the regional banking crisis that happened last March 2023, which saw deposit outflows into pretty much from everything except your most two solid banks, JP Morgan and Bank of America. Now, they have a record, at least there was one positive for the company this quarter, $9.4 trillion in assets under management. That's a record for the company. But the comments from the CEO did definitely not help, guys. The CEO stated they needed to downsize the company, talking about both people and the amount of locations, aka branches, to increase profitability and to move the business forward. That was definitely not well received by Wall Street this morning. Now, the revenue was up small, 1.1% year over year. That's very, very small, guys, underperforming all of your other major banks. Deposits were slightly down on a quarter over quarter basis as well, but down 17% year over year. This is the big kicker as well with the next one. Net interest income down 6% year over year. That's a problem, guys, but it's not a new problem from Charles Schwab. Charles Schwab has been having this problem for some time now. now. Take a look at their deposit history here, guys. You can see, unfortunately, this chart stops pretty much midway through last year, but I'll give you guys the current number and you can see the downtrend has simply continued, right? They really peaked after the pandemic right here in 2022 and have been in a net decrease right now. And right now they're sitting about $250 billion. So this decline did continue ever so slightly into pretty much the $250 billion mark, which they're sitting on right now. So that is what has Wall Street a little bit worried. The fact that the deposits are not increasing as much as the other banks. That is negative point number one. I don't believe it's going to be a longer term issue for the bank. They say it's pretty much cyclical in nature. And a lot of clients, don't forget, have pivoted from just depositing money in their checking accounts or savings accounts to maybe money market funds or CDs, right? Collateralized deposits, which pay 5.5% for a 1 or 2 year term. So those two things are hurting them at the same time. Net interest income being down 6% year over year, guys, definitely one of the weaker performance and all performance in that metric. I'll remind you what happened to Wells Fargo last week. They dropped pretty much 6% on news that their net interest income was down 9%, but they had a nice little rally back. So nice to see them coming back. We will see if the same thing happens to Charles Schwab, but I'd be very careful because number one and this one right here, the deposits and the CEO's comments are definitely going to hurt the stock more than the net interest income, in my humble opinion. The brokerage accounts are up year over year, but down quarter over quarter. Not too much of a change there. And they still have a lot of debt since acquiring TD Ameritrade. So unfortunately, this one, guys, not a very good look. But if for whatever reason the stock does revisit the mid 60s, I do think it's a very decent value proposition down there. The company does have its troubles, but it is getting better, guys. And as they said, the guidance is for 2024 to be a transition year. 2025 should be a lot better, especially in a decreasing interest rate environment for the company. So moving on, guys, that's Charles Schwab. Now let's cover Bank of America, which is pretty much the complete opposite. Bank of America having one of their best days all year, up 5.35%. Very, very nice, guys. And let's take a quick look at an article to that effect right now. So let's take a look. Bank of America shares jumped 5% after saying net interest income rebound is coming. And a lot of the banks shared this same sentiment. JP Morgan said this as well, to where they think that net interest income has pretty much bottomed through Q2 and early Q3, and the remainder of the year into 2025, they should be making more money from net interest income. Now, the firm said net interest income would rise to about $14.5 billion later this year, giving investors confidence that a turnaround is underway. The bank said profits slipped 6.9% from the year earlier to $6.9 billion as the company's net interest income declined amid higher interest rates. Net interest income, guys, is very, very simple, right? It's how the bank makes the most money. It's the difference between how much money they get from loaning out money versus how much money they receive actually when clients are depositing funds and they have to pay out on high yield savings accounts, right? So it's that difference between what they loan versus pretty much what they take in. So as of now, because of high interest rates, guys, that amount has been quite lower. And we took a look at this, guys, net interest income when we went over JP Morgan's earnings, right? And just kind of delved into how net interest income works. Well, it's the main source of revenue, right? Let's say a bank, they borrow at 5.5% at the Fed. They're able to lend that money out at 7%. However, the demand for loans is low. So they can't, even though they can lend at 7%, they're not lending that much. On the flip side, they have to pay deposits on high interest savings accounts around 5%. So yes, they make about a 0.5% basis point margin on the amount of money that they pay out. However, that is a very small percentage. Where they make most of their money is on loans. So when you have demand for loans down and demand for high deposit yield savings accounts is high, well, obviously they get crushed on their best margin segment and they have more demand for their lowest margin segment. That's what takes money away from the bank, right? So Bank of America, let's continue. The firm was helped by a 29% increase in investment banking fees. Asset management fees rose 14%, buoyed by high stock market prices, helping the firm's wealth management division post a 6.3% increase in revenue. Very, very good, guys. Net interest income slipped 3%, however, same as JP Morgan, but new guidance on the measure gave investors confidence that a turnaround is in the making for net interest income. That confirms what executives previously told investors, which is that net interest income would probably bottom in the second quarter, as I was saying. Well, this was JP Morgan's guidance as well. Wells Fargo shares fell on Friday when it posted disappointing net interest income figures, showing how much investors are fixated on the metric. Last week, JP Morgan Chase, Wells Fargo, Citigroup each topped expectations for revenue and profit. A streak continued by Goldman Sachs on Monday, helped by a rebound in Wall Street activity. So I'll figure I should give you guys a summary of most of all your bank earnings that have happened so far. We've gotten pretty much all of them, all the major banks and all the major investment banks as well, Goldman Sachs and Morgan Stanley. All you have to know, guys, is the following points. All fees are up right now. Wealth management fees, private advisory fees, trading and revenue fees, and investment banking, merger and acquisition, and consulting fees. These are more for your investment banks, but your commercial banks like JP Morgan and Bank of America and Wells Fargo have been doing pretty good. So all of the fee-based structure of the business is doing good. What is lacking or falling behind right now is the largest sector of any bank, and that is their net interest income, right? So low demand for loans and clients parked in the high yield savings account affects that. However, we need to understand, guys, the banks are extremely well capitalized this time around. They have a very healthy debt to deposit ratio right now, and they have set forth credit facilities in the event that people do not pay their loans, either auto loans, home loans, or even credit card debt as well. The bank has put to the side money in the event that the consumers are not able to pay. So the banks are extremely well capitalized this time around. And even if we were to go into a soft form recession, we are nowhere even close, guys. Nowhere even close, not even on the same map as where we were back in 2008. So all the banks right now have extremely solid balance sheets, in other words. All of the banks, here's the guidance, all of the banks see a soft landing scenario and consumer strength regaining in 2025. This was issued by pretty much every single bank since last Friday. I went through all of the earnings calls, but just to spare you guys the details, I figured I should do you a very quick summary. So in terms of Bank of America, I like Bank of America for some continuation, but I'd be lying if I told you guys it's my favorite bank. My favorite bank, once again, has to go to JP Morgan. They have the most assets in the game. They have the most solid balance sheet in the game. And usually their investment divisions also are the top tier performers, looking extremely strong. But Bank of America, got to give it to them. They reported a very decent quarter this time around. So that's pretty much everything we wanted to cover in terms of our earnings. I did those kind of in rapid fire format. Hopefully I didn't miss too much. Now, guys, let's jump into some rotation trades before our technical analysis, shall we? So in terms of the rotation trades, guys, right? Obviously, we know what the backdrop of the market is right now. It pretty much looks like this. Bunch of value names. This is the S&P, right? So you're not going to see any small cap growth names here, right? So, but all of the value names have been benefiting from a tremendous rotation to the upside, and big tech has been coming ever so slightly down. So where are we potentially rotating to, guys? I have a couple ideas for you guys, and we're going to start it off from the least possible risky way that we can play this to maybe some of the more risky segments in the market right now, right? So a very non-risky way to play this, guys, is with the RSP, right? So RSP, if you guys don't know, it is the equal weighted SPY. It takes out all of the weights that big tech has and puts every single company in the S&P as an equal weighted partner. So when you have more names that are going up than down, that has been the case for at least the last 5 days of trading. Take a look at today, right? 446 components up, 56 were down. But because of the sheer weight of these companies, you would expect when you see such a broad market day like this, you would expect the S&P to be up 1.5%, but it's not. But what is up 1.77%? The RSP. And you can see how good its performance has been since last Thursday's CPI, right? Really a stark contrast. Was struggling with the all-time highs for a while, since the month of March, now finally breaking out. And I really do believe, guys, that we get continuation. So a very easy play would just be buying the index. If you're not too sure what company to buy, you don't have too much time to research and fumble around between different companies, taking profit, allocating here and there. Well, you could just do a little bit of a mix, right? Since the rotation is into value and the risk on trade, we can do a little bit of a two-step process, right? If I had $10,000 to invest into the rotation of this trade, maybe I put $8,000 into the RSP right now. And then the other $2,000, if I'm going a little bit more risky, is going to be in the Russell 2000, really getting the both of best segments right there, the equal weighted SPY, and then you have your risk on trade, which is represented from the Russell. I agree, the Russell's run a little bit high, but any pullbacks could be a decent amount of opportunity to enter. So that 80-20 ratio really ensures the fact that 80% of our portfolio is safer, and then we allocate a little bit of a 20% to something a little bit more risky to benefit from this rotation out of big tech into everything else right now, right? So that's just how I would play it in the least possible risky format. Then, of course, there's your thematic trades. Think of potential ETFs for some thematic trades for some rate cuts, right? One of them undoubtedly has to be the home builders. Yes, they have run an absolute ton since the CPI data, but I really do think that they have more to run as well. Decreasing interest rates and decreasing prices of commodities really leads these guys into having a great remainder of 2024 and a beautiful 2025 expansion as well. So looking forward to see how much more they can run, but I would not be opposed to playing this ETF as well. Home builders, if you don't want to pick between all the different names, KB Homes, DR Horton, Lennar, Toll Brothers, right? This could be a very decent bet. Another interest rate sensitive sector, guys, that's been largely held down pretty much since the early part of May. I mean, they have rallied a bit this year as well, but pretty much since the month of May, we've kind of been stagnating, right? However, this is utilities. Utilities finally on a gorgeous monthly uptrend recapture, looking to pretty much get back within this trend line. So I really do think utilities have a good chance of hitting those all-time highs, maybe a nice little 10, 15, 20% in this trade in the next 6 to 9 months of trading. So utilities as a whole, they are very interest rate sensitive. And now that rates are coming down in September, this could be a catch-up trade. The other ETF that I'm looking at, well, it's not really an ETF, but it's more of a safer play, is obviously 20-year bonds. The reason I choose 20-year bonds and not 2 or 5 or 10-year bonds is because longer duration bonds are the most affected by interest rates, guys. That's not me saying that. That is just financial theory, right? I'll save you the mathematical equation, but long duration bond securities will rise faster in the event that interest rates come down, right? So the 20-year yield is looking very, very nice for a potential decline here. This is your US 20-year yield. We're really just looking for the eventual recapture by the bears of the downtrend into lower and lower and lower interest rate territory over time. What that's going to be very good for, guys, is bonds, right? So think TLT. TLT is your 20-year bond ETF pretty much. Could be looking for a very, very juicy breakout, even up to levels that we saw back in December, right? So there is a lot of juice left in this trade, in my humble opinion, maybe up to 105, 110 in the near short-term future. Think in the next 2-3 months, that could be decent. And I'm playing it probably through the 3 times leverage version of that, which is TMF, but the safer bet is definitely TLT. So those are pretty much your safer trades, right? Now, let's get into some thematic trades, right? That we're going to look at. We're going to look at individual companies. So number one we have to go for, guys, is definitely some real estate plays. Think either REITs or things that are directly affiliated to real estate, such as the home builders we just saw, right? But here are some good ones. So in terms of REITs, I'm obviously looking at Vici all the time, guys. You guys know me. I've said it a ton of times on the channel, but if you've never seen this one, they are the landlord for the MGM brand of casinos and resorts. They own so many casinos on the Las Vegas Strip and casinos all around North America as well. Extremely strong company oriented towards the casino sector, of course, and entertainment, which has been strong with the consumer. And their rents are indexed to inflation. So you don't have to worry about this company losing any purchasing power on its rents over time. And you do get some share appreciation because Vici actually owns the properties that it operates, right? Contrary to a lot of other REITs. Looking very good on that one. Another one is O Realty. This is your industry leader in triple net leases. If you don't know what triple net is, triple net lease, guys, is basically the landlord basically provides the building and the tenant pays for everything else. They pay for utilities, taxes, general maintenance, stuff like that. The landlord only collects the rent. It's the best possible case for landlord, and O Realty owns so many triple net leases, guys. Think, from quick service restaurant brands to brands like Walgreens to locations like Home Depots, right? So they own all this real estate and all they do is just collect leases, right? Doing very, very well since last Thursday's CPI. I really do think that this one may just start to have a little bit of expansion after being stuck down here for a while, looking very good for that potential trend recapture right here. And it does pay a very nice dividend as well, being a REIT. Now, there's a bunch of other real estate stocks that we can potentially look into, guys, and that's going to be maybe number one, Home Depot. This one's been down for a while, but you can see since that CPI report on Thursday, really starting to get some legs. Inverse head and shoulders finally coming into play right now. And it's really, it's not very close to the all-time highs. Could really see some trend expansion. That's for Home Depot. Lowe's is pretty much the exact same trade, right? They've been stuck in this area for a significant amount of time. Weekly uptrend is back in motion. A lot of that has been the past 4 days of trading since CPI, looking very good, reversing this daily uptrend, reversing into a weekly uptrend, and even the longer term timeframes, guys, looking for that monthly uptrend continuation. Home Depot and Lowe's. This one, Public Storage, it's a REIT, but it's kind of a blend, right? So it is its own brand, but it is considered to be in the REIT category. Very, very nice for that potential monthly uptrend expansion right now. They've been stuck in this area for a great amount of time. And you can see since CPI, popping above a huge level, which is 295 to 300. If they come back, sit on it and run, could be a very, very nice trade opportunity for a tremendously run company. I had this one in my long-term portfolio up until maybe about 6 months ago when I pivoted to Vici, but this one definitely worth a second look if you're interested in something like this. And one last one that's exposed to homes and real estate as a whole, one of the most solid companies in the entire game that nobody ever talks about. The fundamentals of this company are crazy. They are so good, guys. Especially in terms of recapture of EPS. They had an absolute boom, obviously, in the pandemic when everybody was renovating their homes and putting in pools and stuff like that. But this company, for all intents and purposes, guys, almost has a monopoly on the pool business and pool supply business all throughout the United States, whether it's residential or commercial applications, right? For public pools and stuff like that. They provide so much in terms of not only products, but also servicing those pools and stuff like that, and also pool installations. Very, very strong company, guys. Nobody ever talks about this one. You'd be hard pressed to find anything wrong with the fundamentals. Could be a very nice swing trade opportunity after pretty much being down in the dumps right here, looking very, very good for a little bit of recapture, right? In terms of coming back up to this location right here into the 400s and higher. This one is a long-term compounding stock, guys. I would not be nervous at all. And the company does have really, really good net margins, and coming out of a consumer cyclical decline could be a very nice trade, especially with interest rates coming down, because it's a high ticket purchase for a lot of people. Now, moving on, guys, we have some industrial plays next, right? So some of the industrial plays we're going to be looking at, very, very easy plays on solid companies. A lot of these are in the Dow Jones itself here, guys, right? So number one is going to be Caterpillar. Once again, since Thursday CPI, look, we came down to this area, guys, and then massive trend explosion right here on Caterpillar, looking very, very good, trying to recapture the weekly trend as well. And also the monthly uptrend is looking very good for some potential continuation on Caterpillar. Such a solid stock. I'm not going to go through their fundamentals until their earnings, but all you guys need to know, extremely, extremely solid. John Deere, same principle as Caterpillar, right? High ticket items that require financing that have had inventory buildups and reduced demand over the past year and a half. That is all going to change when rates come down. So you can see Wall Street is trying to front run these trades. These are trades that are new. You may think they've already run a lot, but this trade is literally 4 or 5 days old, guys, right? A lot of time left on this trade. John Deere coming out of a beautiful, beautiful, beautiful support location right here. The fundamentals of this business are great. Long-term range of accumulation. Would not be surprised if this one just starts slowly gaining the levels back. That's for pretty much John Deere. Another one that I bring up all the time on the channel. It's in transportation, but as a whole, it is an industrial stock. CP, the railway stock that I continuously talk about, in a range for the past 2-3 years at this point, even though fundamentals have been improving quarter over quarter and year over year, looking for that potential trend continuation right now, want to get this monthly uptrend going back again. Extremely solid company, extremely good management team, solid fundamentals, and good little technical location right here. Now, we can move on to some defensive stocks as well, right? You guys know the defensive budgets are on the up, and these defensive stocks usually perform very, very well, especially with military defense spending on the rise all across the world and interest rates coming down as well, because these projects, sometimes a lot of the things that defense companies manufacture are taken on financing, right? So very, very possible that they have nice rallies as well. Not so much movement on Lockheed Martin, but I do believe this one may just be one of the trades that is a beneficiary of the value rotation. Another one, their direct competitor, right? Raytheon as well could be a very nice continuation trade. Engulfing move, cup and handle on the monthly. Cup and handle is one of the most solid probability trades of all time, guys. And when you see it on the monthly, we can't ignore it, especially coming down into previous all-time high area of resistance, now support, looking extremely strong. And it's Raytheon, right? It's such a solid company. And the last one, another defense stock, guys, Honeywell looking very, very good for that monthly trend expansion. This one has started to get bit up a little bit, but it's looking extremely strong. A lot of these companies have earnings in the next few weeks, but I really like them for some maybe trend continuation here in the second half of 2024 and maybe even to 2025 as well, as rates come down. Stands to be one of the beneficiaries. Another sector we can go in, you guys, you know me, I got plays for you. You guys want plays? I got tons of them. Travel sector, experiences and consumers, right? So a lot of consumers They do sometimes take their, well, I mean, it's not a direct result of interest rates coming down because the trips are, for the most part, not really financed by the consumer, but just the consumer thinking that they have more disposable money because of rates coming down. Travel's been strong ever since interest rates have been high. People have pulled back on goods purchases, but they continue to spend on travel. And you don't need to look any further than these stocks right here, guys. I'll give you the best ones in the entire game. Not going to play around right here with, low quality companies in the travel sector, right? The airlines, the cruises, everybody knows those. Okay, sure. But I'm going to give you guys the best of the best of the best, right? So the best of the best, guys, we have to talk about Marriott. Marriott looking extremely strong for a recapture and potentially push above the all-time high. Gorgeous monthly uptrend. Would not be surprised if this one continues to run throughout that process, right? And if you guys don't know, Marriott and Hilton that I'm about to show you, they don't own the hotels anymore, guys. They split off from that about 10 years ago. All they are a franchise operator right now. They have no skin in the game right now. All they do is collect franchising fees. That's why these businesses are so solid. So if you guys didn't know that, pay special attention to this business model because it's a very, very good one. Take a look, guys. I mean, Marriott, they're so solid, guys. Look at this EPS, right? Yeah, of course, pandemic right here, but then EPS expansion, clear as day. Revenue, yes, of course, COVID pandemic, and now expansion, clear as day. Marriott looking extremely strong. Hilton as well. Hilton Corporation, let me just pull it up right now. Hilton also looking extremely strong. You may say, yeah, but they're beyond the all-time highs. Of course they're beyond their all-time highs, but these companies set new record all-time highs almost all the time, except after a period of uncertainty during the pandemic, and now we finally have that explosion towards the upside. So looking very, very good. I'm not saying bet the farm on these. They could be some plays for some decent continuation or whatnot, but just if they're at the all-time highs, guys, go in small if you like these companies, but these are long-term, very, very solid companies nonetheless, right? And the other strongest one, arguably, of the entire travel industry right now is Booking.com, right? Booking.com, tremendously strong company. Fundamentals speak for themselves. I don't want to spend too much time on every one of these, but just so you guys see, extremely strong expanding EPS, extremely strong expanding revenue, nothing bad to say. Company's balance sheet is also very, very strong. Would not be surprised, guys, if this one just continues running. Yes, it's $4,000 a share, but you guys know the share price doesn't matter, guys. The actual share price doesn't matter. It's all in the valuation, right? And as a matter of fact, I'm pretty sure most people can actually buy fractional shares right now. You don't need to buy one full share. A lot of brokers, you can literally just buy $100 of this stock you want, and you'll get a fractional share. So very, very easy trade to make, in my opinion, right there. That's pretty much it for the travel sector, keeping it to the highest quality companies. If you want to throw in Airbnb right there, no problem at all. Airbnb is also looking very, very decent as well for some trend continuation, right? Looking very, very good, bouncing off this lower 150 to 145 range. Would not be surprised if this one stands to benefit from the continued rally in consumer travel demand as well. Now, let's move into one of the few last sectors, right? So I told you guys it was going to be a relatively longer video on this aspect right here, right? So in terms of your healthcare sector, right? So the healthcare sector, well, you need to look no further than UNH. UNH, even though they're currently at the all-time highs, guys, you have to understand this has been an accumulation range for the past 2 years almost at this point. And when it breaks, it's going to break hard, in my opinion. So I am expecting a break and continuation above the all-time high all throughout 2024 and really back to trend. I would not be surprised if this stock is sitting in the $600, maybe even $700 range at the midpoint of 2025. Extremely strong, guys. The healthcare sector, when rates come down, is going to stand to benefit a lot, in my opinion, from that value rotation. AbbVie, another super solid company as well, right? Currently off this previous resistance area, which is now support for the stock. Looking to get that weekly uptrend back. We're still there, guys. It's still looking good. And monthly uptrend continuation as well. AbbVie, probably also one of the larger winners from this value-oriented rotation. And as a last one, Johnson & Johnson, also in a decent location. They've been bid up over the past couple of days since CPI as well. Looking very good. They do have earnings tomorrow morning, so I'm going to wait to see what they say. But looking very good, guys, for a potential recapture. They will be included in the value name rotation, in my opinion. Even though their growth is not the best, it'll be a case of rising tide lifts all ships. And I do believe that people will give Johnson & Johnson its rotation potentially back to some of the all-time highs that we saw over the course of here, maybe over the next 6 to 9 months, right? So these are longer duration trades, but solid trades nonetheless. Then we can move on to financials, right? There's only a few names that I want to take a look at on financials. We're not going to talk about the banks. The banks have run a lot, in my opinion. JP Morgan will be my top pick, but since it's at the all-time highs, we can look at other ones, right? Rates are coming down, so consumers will be spending a little bit more. Visa and MasterCard have been talking about these almost, seems like every single day for the past couple of weeks, right? Visa, Nice pullback into the previous all-time high resistance, our support area, looking for that trend expansion. Beautiful consolidation. Now looking to expand. Nice touch off the 12 EMA. MasterCard is the exact same trade, guys. Exact same trade. So whichever one you like the best, they're two phenomenal companies. Would be very difficult to say which one is better than the other. Now, moving on, guys, in terms of the other financials that I want to show you guys, this is where we can look, right? In terms of financials that stand to benefit from an equity rally as well, right? So Blackstone Group, right? Investment management company, not well known by a lot of people, but this is such a gorgeous pattern here, guys, right? Weekly trend recapture, break out of this range, looking for some continuation of the all-time highs. Look at the monthly. Monthly is looking gorgeous for some expansion into the all-time highs. One of my favorite companies, I don't talk about them a lot, but their margins are very, very, very good for what they do. And the fundamentals speak for themselves, guys. Ever expanding EPS, ever expanding revenue as well. Very, very solid company that not often gets talked about. They're an investment management company, right? BlackRock as well. We touched upon their earnings yesterday. I really do think that BlackRock is on their way to maybe start challenging their all-time highs as well, severely trailing the S&P 500 year-to-date. Year-to-date gains are only up about 5%, so severely trading below the S&P 500. Would not be surprised if the monthly uptrend on this one continues as well. Then we also have the other pair that we look at a lot, but these are at the all-time highs. SPGI could be a very, very big winner here in the next year of trading, right? We cover them a lot on the channel. Moody's Corporation, for the exact same reason, the ratings business is going to get a lot of attention, their analytics business as well, and their ETF, well, Moody's doesn't have it, SPGI, right? But all these companies that have ETF-based revenue will be going up. Moody's doesn't have it, just pretty much the rating agency and data analytics, looking very good for some continuation as well. And that's pretty much everything for your financials, right? Now, moving into some consumer discretionary stocks, the before last segment, and then we go into the pure risky stuff. Now, consumer discretionary, there's only a few stocks in consumer discretionary that I'm going to touch. No Starbucks, no Nike. Their business models are being challenged. I'm talking about companies that have the same solid business models, but that could represent a decent investment opportunity right now. Domino's Pizza, they have earnings on Thursday. Curious to see what they have to say, but Domino's Pizza, I would not be surprised if they are one of the beneficiaries here of a decrease in interest rates, recapture of consumer purchasing power, and pretty much run, guys. Domino's Pizza, extremely solid company, very, very solid fundamentals. I'm going to wait for their earnings, but if they do have a little bit of a dip here down to 470, 450 after their earnings, that's going to be one that I'm looking to play myself. They have, after falling off here, right? Funny to see after CPI, they benefit from that same rally that the rest of the market has had. So I'll keep a close eye on their earnings if we get a little bit of a dip in this area right here. Could be a juicy location, monthly, high or low for further trend continuation. And the other one I'm looking at that I took a position in myself today is McDonald's. McDonald's lower area of support right now, 50 EMA on the monthly. McDonald's very rarely loses the 50 EMA on the monthly going back 15 years of time, except for during COVID on the weekly as well. 200-day moving average on the weekly. How many times has McDonald's lost the 200 weekly EMA, guys, in the last 15 years? Once during COVID and a tiny little blip here in 2015. Love this trade right here. And this could be one where we get a significant recapture of this rally over the next 3 to 6 months as this rotation into value-oriented names that still have largely unaffected business models, because we know that consumer discretionary spending is a little bit down on McDonald's. They've hinted on that, but I really don't think that their business model is being challenged whatsoever in that respect. So those are the only consumer discretionary trades, and maybe this one right here, UPS, right? Just for shipping services and whatnot. They've been really bogged down because of higher interest rates as well. People obviously ordering a bit less from them. But if we have anything to take from FedEx's earnings that they put out just a few weeks ago, that is pretty much on the shift. FedEx noting a big shift in consumer demand for pretty much shipping services and whatnot. So their business, after pretty much being down in the same amount of time, which is what happened to UPS, right? UPS has not had their earnings yet, but I do think that largely it's going to be a case of the same on their earnings in just next week's time, as a matter of fact. And they've already had a substantial rally since pretty much last Thursday CPI, but they're still very, very low here, guys. Even here, right, on the weekly, looks pretty good for that eventual trend recapture and business returning back to usual. So that's a nice one on a dip right now. Now, the riskier things, right? The riskier things will obviously be included the Russell with the TNA, right? 3 times leveraged on the Russell. This one potentially has some room to move, but think longer term, right? 3 to 6 months down the line, this one will probably continue performing. So the short-term entry, I know the Russell has moved a lot. If we do get a little bit of a pullback here on the Russell, right, back down into these locations right here, probably going to start a position on TNA. That is one of your riskier bets. It's a 3 times leverage on the Russell, the small cap industry as a whole. The other risky trade, guys, as part of the risk on trade, we can't forget about Bitcoin, right? Cannot forget about Bitcoin, especially in the event of a Trump presidency with his newly selected VP, JD Vance, who is a very, very big crypto proponent, right? So moving on to Bitcoin, guys, same logic applies. Gorgeous monthly uptrend, looking for that trend continuation, guys. And this one's going to benefit from any drops in the dollar, any drops from yields, and any further continuation into the risky trade by Wall Street. They are going to bid this one up as well. My price target on Bitcoin by the end of 2025, not 2024. 2025 is about $120,000 for that trend expansion. So we do still have a lot of room on Bitcoin. If you think it's moved a lot, probably not the case, especially as part of an overall bull market. Not financial advice. Crypto can move any direction whatsoever. Of course, it's just a trade idea. And the other one, guys, is solar. Solar got crushed a ton, right, in the last year because of interest rates. It's finally starting to come back a little bit. End phase since the CPI report coming back nicely, but still at relatively low levels. Can I start building a position down in these lower levels for the eventual recapture of their business when demand comes back 2025? Yes, but the positioning starts pretty much around here, in my humble opinion. And the other leader in the industry, guys, FSLR, can't leave them out. They're kind of like a utilities play as well at this point, because most of their installations are pretty much utilities. Coming back down into a very nice area, could be looking for a little bit of a shift. And same thing, guys, right? Just pretty much looking for that eventual trend recapture and keeping these monthly bulls in full control for the trend progression later on in the year. Those are also looking very, very good. And obviously, as part of solar, guys, we have to include Tesla as well. Tesla's run a ton, but you know, if ever we haven't taken positions yet, if Tesla falls a little bit, just think of Tesla when you think of potential trades that could benefit from a decrease in interest rates. So that is pretty much everything, guys, for your, rotation segment of this video right now, right? Now, what we're going to do is I'm going to fly through indexes and big tech names because I spent so much time on other trade ideas. I felt it was necessary. So let's get right into it. All right, guys, so taking a look at the SPY, very nice daily uptrend continues at the SPY at this point, right? Still not as high as the RSP, but that's because big tech represents such a big weight. It's not allowing the SPY to fly as much as its counterpart, the equal weighted S&P, right? So daily uptrend is confirmed. Daily higher low is still right here, 555.56. Just looking for maybe a daily higher low for continuation. As long as this rotation maintains healthy, SPY should have no problem continuing gaining levels. If ever we lose the levels, however, as part of broader market consolidation, just understand there's so much space on the weekly, guys. Anything pretty much above 520 going to be looking for a higher low for potential weekly trend continuation. QQQ, largely the same, although we do have a big tech pullback right now. Pay very, very close attention to this level right here. 490.8. If we lose this over the course of the week, daily downtrend on the QQQs will be started, and we will be looking for a little bit of weekly consolidation on the QQQs. The higher low is right here, 474.83. If we were to pull back into the location, expecting the bulls to pull up a little bit of support before a potential continuation of the rally right there. And if ever big tech really has a big rotation to the downside in terms of maybe a weekly downtrend, then just looking for monthly consolidation. But so far, no signs of that. The bulls still do retain control of this daily uptrend right now, but we have to be a little bit careful when we see continuous 4 days of that, right? Moving on to financials right now. Financials just tearing it apart, guys, after these most recent banking earnings. Beautiful daily uptrend is still underway right now. As soon as this move is topped out, keep a very close eye on your overbought RSI conditions. As a result, keep an eye on the hourly trend. If we lose the hourly trend, significant fashion, losing this 12 EMA on the hourly as well, daily consolidation will be underway, looking for a higher low, anything above 41.4. Daily higher low for further trend continuation. I'd be targeting, guys, the prior all-time high resistance, that yellow line, into newfound support. If we come back down into here, could be just a case of breakout, retest, and run. And even on the weekly, guys, even if financials choose to take a little bit of a breather right here, no problem at all. Just looking for weekly higher lows for further trend continuation. Looking very solid is financials. Moving on to XLV Healthcare. Healthcare with the UNH earnings, guys, today was absolutely crushing it. The daily Momentum by the bulls is substantial right now. Daily downtrend was in motion, and now they didn't even stop. They didn't even pause to set up a daily uptrend. This is just one single move higher, looking extremely bullish. When this move tops out, keep a very close eye, guys, once again, on the hourly trend. If we lose the hourly trend in a significant fashion in the near-term future, just looking for a little bit of daily pullback, and keep an eye on the prior all-time highs, which are right here. Could be, once again, a case of breakout of the all-time highs, retest the all-time highs, and maybe run a little bit more. And even the weekly trend would support that expansion here, guys. Gorgeous weekly trend expansion. So any short-term drawdown into this area right here should be a buying opportunity for some continuation into further all-time highs. Throughout 2024, healthcare stands to be one of the largest beneficiaries from that interest rate reductions. Moving on to semiconductors right now. Sorry if I'm talking a little bit fast. Just got to get through these, right? Moving on to semiconductors. So semiconductors, not as strong as they once were, right? A little bit of the hype is fading. We will see what happens with them after ASML and TSMC earnings. The growth of the sector is going to be front and center for all semiconductors reporting over the course of this quarter. Now, moving on, daily uptrend still in motion by the bulls right now. They established the higher low right here, 270. If we break 270 to the downside, daily downtrend is in motion, and you do have weekly consolidation. Then we need to keep a very close eye, guys, on 256.57. Lose that, and you lose the entire weekly uptrend, and could be due for a little bit more consolidation. As of now, still okay. First line of defense should be right here in the event we do lose that. First line of defense, 264. Prior resistance should be newfound support. We will see how this index holds up as we get the continuation of the rotation out of a lot of semiconductors and into the rest. But not looking so bad yet. We'll keep close eye on this one day at a time. Now, moving on to the Russell. Russell, another absolute monster of a day. RSI on the daily now, about 80, guys. 80 is high even for the Russell, right? For us to get an 80 read on the Russell on the daily, we would have to go back, not even 2020 and 2021, that ridiculous rally, right? We'd have to go back all the way to 2017, which is right, this little guy right here, right? Little guy right here. And you can see it doesn't hit 80 that often before getting a little bit of a pullback, right? So when it happened right here, sideways, a little bit of a larger pullback, and then continuation. And even when we hit it a little bit here, right? A little bit sideways consolidation, one further move up, and then sideways consolidation for a lot of time, right? So the Russell, I wouldn't be buying it up here, even if it is maybe the best continuation trade right now. A bit tough for me to buy it up here. I would more be keen on waiting for a little bit of a retrace. And as I said, guys, now that we're significantly above the 210 to 212 location by a wide margin, I'm really not expecting to get back there. If anything, we're already challenging on the weekly, guys. Look, we're already challenging this massive area of resistance right here and making quick work of it. The end of that top region right is about 228 up to about 232, this $4 range, and we're kind of already there, right? So if we kind of blast up in this area right away and then maybe get 1 week's worth of pullback, I need to see a pullback. If we pull back from here, as a matter of fact, right, keep a close eye, guys. Sorry if I'm flipping through the time frames a bit quickly. 1 hour overbought. If we lose this hourly time frame, lose the hourly trend, daily consolidation, I will be looking to buy that daily consolidation and build a position all the way down. If we do get back down here, guys, I'm not saying we will, because now we've run a lot since that area, but I'll be building a position on any daily pullbacks into the IWM Russell just for that eventual monthly trend. Let me zoom in a little bit. Monthly trend continuation past the all-time highs throughout end of 2024 and in 2025. Now, moving into the Dow Jones here, guys. Dow Jones just really blasting off, guys. One of the Dow Jones's best days, as a matter of fact, all year. As a matter of fact, in the last maybe 6 to 9 months at this point, extremely strong day for the Dow Jones. And that's for a couple of reasons. Number one, United Health. Don't forget, guys, Dow Jones is a price-weighted index. It is not a market cap-weighted index. It is weighted by price, meaning the highest weighted companies in the Dow Jones are the ones with the highest share price. I know it's a little bit old school, but that's just how the Dow Jones works, and it's how it's always worked. And obviously, when we have such outperformance by the top performing companies in the industry right now, United Health with their earnings, Goldman Sachs with their earnings, Home Depot on a rally, Caterpillar on a rally, right? A lot of their highest companies, guys, are starting to go on a little bit of a rally. That's why the Dow Jones has so heavily outperformed here today. As a matter of fact, even with a slight decline in Microsoft, which is one of their top holdings, right? So Dow Jones looking very, very good, guys. Hard pressed to find anything wrong with this chart whatsoever. Daily uptrend is substantial right now. We're going to be looking for a little bit of a pullback. Dow Jones at 81.5. Go back to the last time it hit 81.5 right here, and you can see we got a little bit of sideways consolidation before putting in another leg. So it's not to say that necessarily we have to see a big decline, but maybe just some sideways consolidation for the Dow Jones. Cool off these time frames, guys. You can see we haven't hit this pretty much since 2017 would have been the last time if we weren't to use this 2023 one right there. So you can see it doesn't stay up there for that long. If we do get some pullback, guys, right? Just looking for a daily higher low for the eventual trend continuation. And even if it leads into a little bit of daily downtrend consolidation here into longer form weekly pullbacks, just know your bulls are in full control. Weekly uptrend, looking for a weekly higher low. Target the prior all-time highs in the event of longer form consolidation. 39,900 for a little bit of a breakout, retest, and run beyond the all-time highs. Looking very strong. Now let's move into our big tech names, shall we? So big tech, we're going to go through these quickly as well because we know what we've been expecting and now it is finally coming true. So the Apple moving nicely on the day, 0.18% to the upside. Gorgeous daily uptrend on Apple right now. We will be a little bit cautious, however, because it is one of the big tech names and has had a tremendous rally, so could be due for some extended consolidation if ever this rotation continues on a meaningful basis in the next few weeks. So daily uptrend, guys, daily higher low is right here, 225.73, looking for the new daily higher low for continued trend expansion. However, if we lose this right here, let's say the bears take back too much, end up in a daily downtrend, and even Apple consolidates, we'll just know on the weekly tons of space, anything above 204.70, anything above, let's call it about 207, all right? Anything above that, gonna be looking for a weekly higher low for further trend continuation. I wanna play Apple as close as possible to 218, so I won't be touching it up here, but it is on my candidates for a swing trade if ever we pull back. 218, 215 location down there. Moving on to Apple looking healthy. Moving on to AMD right now. AMD doing pretty much picture perfect what we wanted it to do, guys. Gorgeous daily trend expansion, getting rejected at the 185 level, which is a big area of resistance in the past, getting rejected. And where are we retesting? The exact label we've been labeling, exact area we've been labeling on the chart now for about a month of time. 173 down to 169, coming down, breakout, retest of this range of resistance, which is now support for the bulls. The moving averages are there too, and maybe just looking for a little bit of continuation further down the line as earnings approaches and the release of the Ryzen 9000 series of CPUs that are coming out this month as well. So far, not yet released, but we do have some data leaks on those, and they do appear to be quite good, looking very strong. Right now, just dealing with a little bit of weekly consolidation, guys. Gorgeous weekly uptrend, looking for the weekly higher low for further trend expansion. And AMD, guys, even on the weekly, look how beautiful this chart looks. If we come down lower, 173, 169, definitely buying this dip to potentially get another rally higher, closer to its earnings. I don't really consider AMD to be big tech. It's really been left behind, especially since it's the rally that it had in March, right? It's done pretty much nothing. So it does still have a little bit of room to move, in my opinion, to the upside. Moving on to Amazon right now. Amazon is part of the consolidation trade again. So Amazon, unfortunately, losing the daily uptrend right here, setting up for a potential daily downtrend in motion. That would be a break of 190.84. Daily downtrend would be underway for Amazon. And since we are so close to an area of prior resistance, should be newfound support for the bulls. The 50 MA is sitting right there too. I do expect the bulls to have a nice one-touch bounce for that. Now, whether or not they continue lower is a different question, but we should be able to get a nice little bounce in this area. In terms of the weekly, we are already in weekly consolidation mode with that daily downtrend in motion. So looking for a weekly higher low, so much space on Amazon, anything above 174.18, looking for a weekly higher low for continuation of the uptrend. So once again, guys, 190 down to about 185. This sweet spot right here could be an area where Amazon consolidates a little bit and then maybe has an extension of their rally closer to their earnings cycle, right? Which is pretty much towards the end of the month, 25th of July, but no red flags, just part of the overall consolidation phase. And I'm not saying that big tech necessarily has to do this, right? But maybe they just don't move up as aggressively. Maybe they just continue, sideways accumulation, then slightly higher, but maybe the outsized returns come from the rest of the market. We're not expecting a big tech collapse here, right? Just not as hot, not as heavy momentum as maybe they had this entire rally right there. Moving on to Google right now. Google as well, same concept, right? Just daily consolidation, 1.43% of the downside. Nothing wrong with the company, just an overall rotation trade. So Google, unfortunately, setting a daily downtrend in motion by flushing the daily higher lows right there. So daily downtrend is underway on Google right now, which means that we are in weekly consolidation already. On the weekly, at least, a lot of space for the bulls. Nice weekly uptrend. anything pretty much above 171, looking for that weekly higher low for further trend continuation. Target this line right here. Why is it so important? Same thing as Amazon. Prior all-time high resistance should be newfound support for the bulls, looking pretty good around the 180, and also the 12 EMA on the weekly is sitting right there as well. So a little bit of maybe a touch and then a further attempt at the all-time highs could very well be possible for Google. Keep an eye though, guys. They do have earnings in the month of July. So looking pretty good, guys. I wouldn't be surprised if big tech really does well on their earnings, giving them one last gap higher and maybe just some consolidation for some extended time as the rotation simply continues, right? So looking pretty good, guys. I will be a buyer of Google. If we come lower, 180 down to 175 is where I personally want to be playing this one myself. Moving on to Meta right now. Meta also continuous consolidation on Meta. So unfortunately, daily downtrend on Meta is still underway right now. That is clear as day. So daily downtrend, what does that mean, guys? You zoom out and it means we're in weekly consolidation, unfortunately flushing the weekly higher lows already. So this was a nice weekly uptrend that Meta had, and now they have lost it. It's not a weekly downtrend. Weekly downtrend will be lower high into lower low, but they've definitely lost the weekly uptrend. At least they can find some solace in the fact that there's a big area of support down here. 480 down to about 460. One thing's for sure, if we come close, guys, 470 down to 460, I will be looking to pick up some Meta shares. They're now down. If they would come all the way down there, there'll be a 15% decline off the all-time highs. And usually Meta, when we get a 15% decline off of highs, it's usually a decent buying opportunity. So I do believe the bulls are fairly strong. Nothing wrong with the businesses at all. Just as well some continued rotation to the downside, as a matter of fact. So looking good. I will be buying Meta down here, but now definitely part of that consolidation trade. Moving into Microsoft right now. Microsoft, same concept as well. So Microsoft as well here, guys, losing the daily uptrend. Unfortunately, is Microsoft will actually, losing the lows right here. If you want to take it in a more broad sense, daily downtrend right now, losing some of your more important levels, which means we are in for a weekly consolidation already. On the weekly, tons of space for the bulls right now, guys. Anything above 404, looking for a weekly higher low for continuation of the uptrend. Target this area right here, guys. Once again, 440 down to 430. If we can get a retest of the prior all-time highs with some consolidation, that will be a decline from the highs by Microsoft by about 7 to roughly 8-9%. Even if we dip a little bit lower than that into further of this big support range right there, that could be a nice buying opportunity for Microsoft for the eventual continuation. Nothing wrong with the business. Once again, as I said, just part of the rotation trade. So Microsoft, any and all dips below 430, think more 435, 430. That's where I really get interested in this stock. Moving on to Netflix right now. Well, Netflix is going to be really impossible to do because they have earnings pretty much on Thursday, right? So 2 short days of price action for them. We will see obviously what happens. Now, in terms of Netflix, guys, right? Looking maybe for the lower high into lower low, but with only 2 days of trading, this one could go either way. The expected move on Netflix right now is about 7.58% for the week. So that could either put us one of two places. It's either going to put us at the all-time highs, or in the event that earnings are lackluster, it's going to put us right back into this big support zone, which is your 634 down to about 606. Now, if we do come down to the lower end of this after earnings, I will be looking to pick up a bit of Netflix shares, knowing full well though, guys, that it can maybe drop a little bit further. Still in a nice weekly uptrend, but be wary. If we lose this level after earnings, we will be losing the weekly uptrend. But same thing that happened right here, right? Weekly uptrend into earnings make them lose the weekly uptrend. They can then recapture it, no problems at all, but we just have to be mindful that we may come down into this lower location, 605 all the way down to about 580. This spot right here is where I would really want to pick up Netflix in the event of an unfavorable earnings event. Moving on to NVIDIA right now. NVIDIA also coming down on the day, and NVIDIA, one of the semiconductors now, SMH did not set the daily downtrend. You guys want to see it again, right? SMH holding, not setting the daily downtrend just yet, but NVIDIA, the largest component of them, setting a daily downtrend in motion. So daily downtrend on NVIDIA, first time, has to be noteworthy. First time since we had this one back in the month of April. So daily downtrend underway right now. Next step, guys, you obviously know, is we are in weekly consolidation mode. So weekly uptrend is nice right now, but we may just be in for a little bit of a tightening range. Keep a very close eye on 119 down to 115. This green box of support, which lines up with the 12 EMA as well, may just be time for NVIDIA to sideways consolidate, grow into its valuation, and pending its earnings in the early part of the month of August, especially if we continue to see a little bit of semiconductor weakness after them being so strong. Not a bad thing, even though NVIDIA could consolidate sideways. However, guys, take a look at what happened right here. Consolidation sideways does wonders in cooling down the RSI timeframes for a future rally. The weekly has cooled off quite considerably. The daily has cooled off quite considerably as well right now. So everything is looking very, very good. Sideways consolidation as of now. No major red flags. A larger red flag would be losing this level 118. Give me a weekly close below that. Weekly uptrend is lost, and NVIDIA has not lost the weekly uptrend since a tiny little fraction back here in the month of last October. Moving on to Tesla, I will be, for NVIDIA, by the way, I will be looking to continue to play short puts around the 119 to 115 level as we pull into this location right here, but just being mindful of the potential effect that further downside could have on the stock. Maybe coming all the way down to about 110, even 100 right now is not out of the question, but that will be very, very long form consolidation, maybe up until their earnings in August. Moving into Tesla right now. So Tesla also looking quite decent today, right? They started off the day red, but now looking pretty good. Tesla still a daily uptrend, clear as day right now, but maybe just in for a little bit of consolidation, right? Now, the bulls do have a chance here, guys, at setting a daily higher low right away and maybe moving on to a new daily uptrend. Now, as of now though, guys, just a little bit of a tightening range. You can see that best on the 4 hour, right? Very, very tight range that's happening right now on Tesla. The bias is still bullish in my humble opinion, especially leading in to the earnings 23rd of July. So what are we expecting from the bulls right now? They do have one chance to maybe continue this to the upside, continue the daily uptrend. However, if we get some extended consolidation on Tesla until the time of their earnings next week, pretty much, well then, everything will be relying on earnings. And you guys know Tesla, it can be very volatile. Expected move is probably going to be about 9-10% this time around, which could really bring us down lower end of the support range right here, 225, or could really blast us up all the way up to the next resistance zone, which is pretty much your 290, 300 level, right? So not that much time before earnings still. Curious to see what happens. One thing's for sure, guys, if prior to earnings, we revisit some of these levels right here, think 240, I'll be looking to write short puts, guys, 225 and below on Tesla, just trying to be as safe as possible as I can, because this one is definitely going to be very, very volatile. But I kind of do want to position, if we do come down here prior to earnings, I may just throw some 2-3 month call options at it in the event that they really smash it out of the park and we get another weekly leg higher. Moving on to Palantir right now. Lastly, so Palantir not looking too bad at all here today, right? So Palantir, gorgeous, gorgeous, gorgeous continuation of a beautiful daily uptrend, right? So clear as day, daily uptrend, a little bit of consolidation, and now looking to run a little bit further, still closing above the $28 level. And this is an important level, guys. Largest area that we pretty much had since 2020 and 2021. But the longer term timeframes are looking very good for that weekly continuation higher and even the monthly continuation higher too. Nothing is overbought. Monthly is not overbought. Arguably the weekly is not overbought either. And even the daily, since we've been getting really, choppy moves this whole way up and not just move like this, well, your daily is not overbought either. So I really do believe in the bull's capacity to maintain this. However, lose 26.93 to the downside, you lose the daily uptrend, open up the doors for daily downtrend, open up the doors for weekly consolidation, and could be a case in point for retesting 26 to about 25 prior resistance, newfound support, looking for that breakout, retest, and maybe run thereafter. So that's pretty much everything I had for you guys in terms of the technicals for today. Hopefully you guys enjoyed that. Now let's take a very brief look, because I want to keep it short, very brief look into my portfolio for trades made today. All right, guys, so taking a look at the portfolio here, there is a few trades that I closed this morning. Now, I'll do the total P&L at the end of the week for you guys on the Friday video, but just so you guys understand, right, you guys remember that I took the UNH put credit spread yesterday, right? 20 contracts. Happy to say that we closed them pretty much for 2 cents today. So we took pretty much a 90% profit, realized almost $230 in gains. And unfortunately, almost about half of that, more than half of that, was offset by the big loss that we took on Charles Schwab. It wasn't that big. I mean, I limited the damage, but just to understand here, guys, when we're running an earnings strategy, right? Anytime, whenever the stock price opens the next morning, guys, we close relatively soon after the open. 5 to 30 minutes after the open, we are closing these. I'm not going to wait for Charles Schwab the rest of the week, similar to the rest of the wheel strategy that I run. I'm not going to wait to see whether it recovers or not, and then write covered calls on the position. No, it's an earnings play. I am closing it and taking the capital and moving it on to the next trade. The goal here is to trade often, right? Trade small and trade often. That's what we want to do. So moving into Charles Schwab here, guys, you can see that Charles Schwab, we wrote this one yesterday. We had a put credit spread here for only about 13 cents. We closed that at pretty much minus about 60 cents, took about a $50 loss right there. We also did a few of these things right here too. Right, so Charles Schwab, we wrote the 70 short put for 22 cents, and then we also took another contract, which is somewhere in here. We have another one for the 69s. Where is it? 69 short put right here for about 16 cents as well, right? So 16 and 25, we didn't close those for too bad, right? So the 69s are 16 cents. And 70s are about 25. And you can see when we closed them this morning, I closed them at 10:34 a.m. shortly after the open, was just reading the earnings report and getting a sense of the company. And then I pretty much closed it pretty much an hour after the open, right? Didn't hold on to it too much. $70. I could have closed it right at the open, but I wanted to give it a tiny little chance for about a half an hour maximum. It could have dropped even more, guys. And pretty much I would have taken an even wider loss. But you can see here the closing trades on those. The 69s, we closed them for 46 cents. So pretty much $30 loss on those. And then these that we got for $25, we closed them for $88. So, roughly let's call it like $60 loss on that one as well. So all in all, guys, we lost about $140 on Charles Schwab. Not that big of a deal. Made a lot more money on the actual, on the UNH trade than we did lose on Charles Schwab. And Bank of America, we closed those pretty much worthless as well. So I don't know where the closing trades for Bank of America are. They're right here, but you see we closed them for a penny. We had them for 10 cents yesterday, closed them for a penny. So those are pretty much the recap of all the earnings trades, right? Then in terms of new trades for today, very simply, one contract only for Ally Financial, 39.5 puts for 9 cents. Once again, an earnings play. They have earnings reporting tomorrow, pretty much before the open right here. So I have them for earnings. I have another play for earnings, which is pretty much down here. That's going to be Johnson & Johnson, 144 puts, pretty much 2 standard deviations in a nice support zone. 144 puts on Johnson & Johnson, $21 for them in terms of net credit. So we'll see what happens for them tomorrow, but fairly confident in that position as well. They have earnings tomorrow before the open. And then, of course, we have the big one, which is going to be ASML. But obviously, you know that their share price on ASML is very expensive. So it's very expensive to do long calls, long puts, or anything like that on a stock like this. Even short puts at this level right here, yeah, that's like $95,000. Not a lot of people can do that, right? So what I chose to do on ASML is pretty much what I've been showing you guys to do over the past couple of weeks, which is a few different things. Number one, I have a bull put credit spread 940 to 930. This is 2 standard deviations from the expected move. The expected move on ASML, let's just pull it up right now, as you can see. So I'll just give you guys the example. The expected move on ASML right now is about 5.4%. So I went pretty much double that, right? I went at the 940. 940 is 12% away, right? So how much money did we get for that? We pretty much got $35 for it, and we're risking $1,000. So the ROI on that is 35 divided by 1,000. It's just going to be 3.5% for the week, but we're probably closing this trade as early as tomorrow morning. So in all reality, the ROI per day is a lot better than this, right? Yes, we are risking $1,000 loss to make $35, but we're doing it in the least risky way possible, right? Yes, the put credit spreads, the way I'm doing it on the weekly is a more risky strategy, but we're trying to grow. As I said, guys, I'm taking 5-10 grand of the account and only doing high growth strategies, 2-3 month away long call options, and aggressive put credit spreads on a weekly, bi-weekly, or maybe in 3-week out basis, which I'm going to show you guys in the future. But these are earnings plays, right? And then we went with a bull call spread. So bull call spread, the 185s versus the 190s, that is for upside potential gains. And obviously call options are very expensive on ASML. So to make it a bit cheaper, we go with the bull call spread. Now, we paid $204 for each of these. There are 2 of them. Now, what can happen, guys, is the best case scenario, even if ASML tomorrow goes to 1,100, 1,150 or whatnot, we'll probably only be able to close about $3 on these. So I'm looking to make about $100 on each of these. If I can make $100, which would be 50% gain in one day, that would be very nice, right? The total gain that you can possibly make is 5 minus your 2 pretty much, which is just about that, right? So you can make pretty much, $500 total on this one right here, minus your cost of 200, which is 300. So if I can realize all that 300 come tomorrow, let's say if I can get 290, 295 to sell these for, that's what my take profit is on them. And that's what we're going to try and get. So looking good. Put credit spreads and debit spreads, very, very simple. These, the maximum loss, guys, is just your initial investment. No more than that, right? It's not like the put credit spreads. The bull debit spreads, the max loss is how much you pay for the contract. Besides from that, did we open a couple new plays at all today? Not really. The only ones that were newly opened today are the ones with the blue dot. So I went with some call options on Bitcoin 2x leverage ETF, not financial advice. Don't do this. You'll probably lose money. Wink, wink, right? So I went with these, a bit aggressive though. We went with the $37 call option, which is pretty much at the money, $9.65 for the month of December. Then we went in the money with the 30s, right? We paid $12.10. Didn't get the high of the day. This right here, the closing bid is wrong. It's actually closer to 12. We're not down on these too much. Just looking for some continuation on Bitcoin into the end of the year. Donald Trump presidency, risk on trade. Both of those things, guys, should lead to have Bitcoin into rally mode, perhaps. At least that's my thesis over the next couple of months. So looking at some call options for these, but a little bit risky. Total exposure about $2,000 plus the $500 in shares that I have somewhere down here. Where is it? BITX shares. Yeah, they're right about here. 20 shares, right? So total exposure, $2,500. Very, very leveraged. This is a 2x leverage ETF, and I'm playing call options on it. So there's even more leverage, right? And on the riskiest asset of them all, apparently, which is Bitcoin, right? So full risk on, fully ready to lose all my money. We'll see what happens. Keep an eye on this one, guys. Nothing much else changed here, guys. Oh yeah, this is one that I did want to talk to you guys about, right? So there's another trade right here, which is pretty much your McDonald's. So I went with the McDonald's October 18, 260 call, slightly out of the money. I am looking for McDonald's to be part of the value trade rotation. They have earnings next, or in 2 Mondays rather. So taking a little bit of gamble that earnings won't be too bad for the company. It's usually not that much of a volatile event for them. Just looking for monthly or weekly recapture of the trend and a little bit of a monthly bounce for McDonald's. If we can get back up into the high 260s, high 270s, these call options should be pretty nice. Gave myself a lot of time on them, about 3 months worth of time, and they're slightly out of the money. We paid $9.14 for them, and this right here is wrong. The stock, they actually closed right around where I bought them. Actually, as a matter of fact, a little bit up. They're pretty much trading between 920, 930 right now. I opened them not early at all here, guys. I was just shopping around towards the end of the day, saw McDonald's was having a good day and figured, you know what? Let me throw something at it right there, looking for the daily uptrend recaptured after being stuck in this daily downtrend now, or daily and weekly, downtrending patterns here since the month of pretty much March, right? So looking for this one to start to rally. Very, very defensive name as a whole, guys. So there it is, McDonald's, October 18th, 260 calls. Do with that what you will. Now, moving on, guys, there's one more trade that I took, and that was NVIDIA, actually 2 more. NVIDIA 119 puts. We opened those early on in the day when NVIDIA was down. 55-cent credit, not quite 0.5%, but I'm staying relatively, careful on this one as a whole. We're already in profit on those. And another one that I did close that I didn't show you guys, my bad on that. It's the AMD. We took AMDs yesterday, didn't we? So where's AMD? So all these contracts, I'm very sorry, guys. It's the byproduct of trying to show you guys more trading strategies is that we just take more trades, right? A stark contrast from the beginning of the year when I would only maybe take 5, 7, 8 trades per year. AMD 170 puts, wrote them for 150 yesterday, and we closed them today just to reallocate the capital. Made pretty much 50% in one single day. 84 cents was closed, so not quite 50%, but almost. Took the capital, guys, and put it back to work elsewhere, right? Then we also took TMF, starting a little bit of a position on that 3x leveraged 20-year bond play. I think it's actually starting to get ready right now. Took it towards the end of the day when it was already up about 4%. We're expecting continuation, right? So even though I don't have the best entry whatsoever, I am still fairly confident in this trade's ability, and we're going to keep this one. I was looking at some calls and stuff like that, but maybe want to get it on a little bit of a down day, because today up 4.5%, not the best time to be buying calls. So we'll keep a close eye on that one. As a whole, pretty much, guys, I think that's everything that I should have been covering for you guys. So hopefully you guys enjoyed today's video. Bit of a longer one, but I felt it was necessary to provide you guys as many ideas and setups as possible. Not financial advice, just ideas, right? Ideas and a different thesis for you guys to think about, and then go shopping for your favorite companies. So if you guys enjoyed it, please consider liking the video for the growth of the channel. Would really appreciate it. Consider subscribing to the channel if you're new as well. We do these every Monday through Friday after the close. And as usual, guys, if you have any questions whatsoever, please feel free to leave them down below in the comments. Stock, technical analysis, options play, macro discussion, anything you want, leave it down below in the comments and I'll get back to you in 24 hours. Take care, guys, and peace.